This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Serezna.
Let's move on to the chart deck. Listeners, you'll find the download link in your Research Roundup email. It says Big Picture Postgame Chart Book. Patrick, energy charts. Talk me through what's going on here. Starting on page 2, you're looking at WTI crude oil futures in the July contract.
Right. Well, Art did a great job explaining what was going on in the crude oil markets, and you dissected it so very well. But I wanted to really take a look at all of the energy markets, gasoline, nat gas, and everything, and just see where the entire energy space, including equities, were. The only observation I wanted to make on page 2 was simply that, well, we had an incredibly oversold oil market, and right now we have more or less 50% retraced the huge sell-off that happened since the start of 2020. And often when you have a very oversold condition, the reflexive rally on the other side often will retrace about half of what the prior drop was. So this is almost par for the course for even in a bear market of what something will happen. So what I think is going to be the most interesting is what oil actually does from here. Because if it's a real bull market in oil that's going to launch from here, it should be able to clear 40 decisively and work its way higher. And if this is where it stalls, then it's really hard to make an argument that the bull market has started yet. It doesn't mean it won't, but it's just it's a level that I think is very relevant for us to watch what happens here.
Patrick, I've been dying to ask you, since you're the technician in the house, what you think about the gap fill. You know, there's such a mantra in technical analysis that gaps have to be filled, although I'm not sure that there's any reason it happens other than people think that it should happen. Now, if we look at the continuation chart, the gap fill level is about 41.05. On the July contract, which is just about to expire, we're looking at 41.88 as the top of that gap fill. On the August contract, I think it's around 42.25 or so. Do you think that is going to act as a magnet to pull the price up? Would it make sense to look at that as a target before this market rolls over, if it's going to roll over the way Art thought it might? How do you see that here?
I think you nailed it when you were referencing that most traders that are observing it, it almost becomes a self-fulfilling prophecy where if enough traders are looking for the same price level, by it being the focal point, and a lot of times it will actually fill the gap. I tend not to trade those moves myself because I think that there's better ways of targeting things. But it would not be a shocker if we saw oil temporarily trade up there just to fill that gap and then give it back. I mean, it would start to look like a pattern of almost like a little head and shoulders pattern if we saw the gap fill and then gives it all back on the other side. I don't have any high conviction if it will happen or not, but it is something that is very widely being tracked. And whenever something is being tracked that much, it's something we have to pay attention to.
Patrick, let's move on to RBOB gasoline futures on the next chart, seeing maybe a brisker recovery there and maybe a little bit more consistent trajectory to the upside. What do you make of this chart?
Well, interesting because it does also have a gap that it's filling that, like you were mentioning, which would have gasoline head to about 140 if that gap was filled. But gasoline has pretty consistently since the bottom been outperforming oil, and the relative strength is very much there. We've already just broken to a slightly higher high, and so momentum is there. There's a lot of talk of driving season, summer driving season pushing gasoline demand. And crack. We'll talk about cracks. Actually, we can move on page 4 there as well. There's the crack spreads, which is the spread for refining oil into gas, which is back to a relatively healthy range. I mean, over the last 5+ years, we've seen crack spreads gravitate between this kind of $8 to $10 bottom end of the range and $20+ on the upper boundary of the range. And while we saw those crack spreads hit zero during the actual oil crash, we're back to ranges where refiners are profitable again in doing this. And so this is one of the really interesting puzzle pieces to solve. Is gasoline going to recover quicker and stronger? And Art talked about that on one of its charts. And right now, there's no denying the relative strength belongs to gasoline when compared to oil, and that will probably continue. What I do, though, want to work into is page 5, where while gasoline has certainly outperformed oil, the one market that has not at all and actually is quite underperforming is natural gas. And it's really interesting because natural gas popped back in April, May, based upon this idea that with the capping of all of these wells, that a lot of the oversupply issues would have been solved. But what is clear at this stage is, at least what the price is showing is that oil prices didn't stay low enough, and not enough wells were shut off in order to really change the supply dynamics in the natural gas market. So here I have the July contract breaking to a fresh low, and the trend is so ugly. It's just down, it's moving from the top left to the bottom right of the chart, and it's just ugly, right?
Well, it's just ugly, but any time that I see a futures chart looking this ugly, it always forces me to ask a question, which is, okay, this is the July contract. What's the August contract doing, and what are the subsequent contracts doing? And so let's move on to page 6, where you're showing the term structure, which is the map of what all the subsequent contracts are doing in price. And boy, I guess my intuition was right on. There's a huge, huge contango. What's going on there?
Well, I mean, you can see the waves, which is the typical seasonality, which prices in those higher winter prices in nat gas. But what is amazing is the complete collapse of these summer contracts, like this July, August, September contracts are all very, very weak. But then it's almost like an explosive steepening, or at least moving up on the curve, where the December contract is almost double that of what this front month July contract is trading at. This is absolutely fascinating that we see this contango exist, considering that in the oil market that we're already very flat on that term structure, right? So, Eric, this is where I want to talk about the UNG, which is the United States Natural Gas Fund, or the ETF that actually trades these natural gas futures contracts. And we've had numerous episodes here where we've talked about the oil one, which is the USO. And the USO, to deal with the fact that they're rolling their contracts, is now spread along the term structure, I think even up to a year out, that they're out on some of these contracts. But what I find fascinating is that even in spite of this massive contango that we're seeing, this ETF is still very much a front month ETF, where they are just right now in the process of finishing rolling their July into August contracts. And so that means this ETF, and you can see on the chart just how much it's underperforming that of the natural gas contract itself. And so what's interesting here is that means that if this contango persists, this ETF is going to eat that contango roll as we get here into the third quarter. What's your take on all of this?
Well, Patrick, this just underscores the reasons that I'm so skeptical of these commodity ETFs. You take a market like crude oil, where it's really important to understand the term structure, and you get a whole bunch of mostly lazy retail investors who don't really know what that means and don't care to find out, and they just kind of take a gamble, not understanding the consequences of backwardation and contango and how it affects the roll performance of an investment like USO. Now, USO is a crude oil contract. UNG is natural gas. The natural gas futures contract is known as the Widowmaker contract specifically because the term structure, the contango and backwardation, has caught so many professionals by surprise. It has ruined careers. It has bankrupted funds because unexpected things can happen in the term structure of natural gas that just blows up all kinds of really smart traders. Why in the world, if a lot of oil traders won't touch natural gas futures, and that contract is given the name Widowmaker by futures traders, because if you don't really know what you're doing, it's so dangerous, even for an experienced futures trader, to trade it. Why in the world would anybody buy a fund like UNG where they don't even understand the underlying term structure implications on the performance of the investment and the tracking errors that it introduces? It doesn't make any sense to me that anybody buys these things. But as you say, right now, for now at least, UNG is still all centered in the front month contract. What happens if they have some crazy dislocation? Now, if you look at the performance of nat gas versus the performance of crude oil, if we go back for a minute to page 6, look at all of those wild undulations in this chart. The reason for that, as you said a few minutes ago, is because seasonality plays so big of a role in the shape of the natural gas term structure. Just imagine if UNG couldn't stay in the front month and had to push their positions X months into the future. Well, over time, where those contracts would either be on the upside or the downside of those really big sawtooth waves in the market. There could be all kinds of profound implications to that depending on how they ended up reorganizing their exposure, if they ever did that. Furthermore, if you're the investor in that fund, you don't have any control over whether they change that allocation or the exchange makes them change that allocation or whatnot. So I don't understand why anybody gets into these. As far as the underlying futures trades here, natural gas, it's called the Widowmaker contract for a reason. You either really, really understand the physical market dynamics of natural gas storage in particular, why it's so expensive and has such a high carrying cost. If you are really expert on that, you can make a killing in this market by understanding and anticipating those shifts in term structure. But if you're not that expert, you don't want to touch the NG futures contract, and that's the reason they call it the Widowmaker.
Right. That's a good segue to then a lot of people are asked the question, well, then how do you play it? And I say that if you aren't someone such as yourself that knows your futures markets and knows how to play it on the term structure, the best thing generally is for traders, investors, especially at the retail level, just to stick with energy equities. I mean, there's enough correlation in the equity markets on energy stocks to the underlying commodities that you don't need to get into the complexities of how the commodities themselves work in the futures markets. But so that's where I wanted to go with on pages 8, 9, and 10, which is what I have the chart first on the Select Spider Energy ETF, the XLE. And at least on this chart, what was interesting was, first of all, how the magnitude of the sell-off, just how ugly that January through to March sell-off really was, where it went from just north of $60 down to almost $20, just a complete and total halving of the ETF. But even though off the low, very similar to how you can express percentages on something like Boeing off of its lows, this ETF doubled in price. I mean, going from basically the low 20s all the way up to $46, $47 on the upside. But what is interesting is that when you really look at the vast majority of equities in the markets, almost all equities outside of financials have mostly recovered back towards those early 2000, well, at least the 2019 levels. And we have not seen any recovery like that in energy. And so while we've had that reflexive bounce, the energy stocks are still very, very cheap. And if oil markets are to improve in the future, maybe they're still trading at a meaningful discount. And maybe this is still a place where one could find opportunities in the future. So next chart, Eric, what I want to look at was the oil service ETF, the OIH. And this one has been extraordinarily volatile. I mean, we went from this thing trading near $280 to it hitting a low down around 65. And similarly, we've saw an extraordinary reflexive rally where it more than doubled, going from 65 hitting a high almost of 170 some odd dollars on the upside. Just a huge rally. The volatility has been considerably higher in this space. And this is interesting to me because in that oil service space, that's really where the big volatility is in terms of whether or not shale will be restarted up again, right? Do you have a take on all of that?
Well, Patrick, we have to remember that in this crisis, what's happened is the frac spread count, that's the number of fracking rigs that are in place and fracturing wells in order to put them into production, just dropped off a cliff. So the companies that are in the business of not actually producing oil, but in providing services to oil-producing companies, and that's what OIH is companies that provide services to the oil and gas industry. They're more volatile for all the same reasons that gold mining stocks are more volatile than the price of the metal itself. If nobody is drilling any wells and nobody is fracking any wells, then you don't need the oil services guys, and they end up completely idled and they start to go bankrupt. But if you listen to what Art said in today's interview, at some point, we're going to get to where we need to try and get back to 13 million barrels per day of U.S. production. And that is not, by any stretch of the imagination, a matter of flipping just a bunch of switches and turning stuff back on. It's about making a bunch of phone calls and calling those companies that are in the OIH and spending lots of money to get them coming in to run their drilling rigs and run their frac spreads and so forth. So eventually, I think OIH is going to do really, really well. But that doesn't mean right away, because we may be going into a second wave where we see a lot of the wells going back and being shut in. And, of course, some of those OIH companies, they get a little bit of business out of shutting wells in. But once they're shut in and idled, it's not until we really get to the next wave of drilling new wells and fracking new wells that those guys really start to make money.
Right. And so let's move on, though. What I want to now touch on is how did the exploration and production companies actually do? And again, this is a space that just suffered immensely on the way down. And they've been trending lower all throughout 2019. This wasn't just a break that started in January for this space, but they've also rebounded quite a bit. And it's just a higher volatility basket than the traditional large cap ones. And what's interesting, and finally the one I wanted to touch on, was the oil refiners, the ones that are actually converting the oil into gas and usually have nice dividends and are much more stable businesses. And they've also obviously had a very difficult time throughout March and have recovered very well. And this is where on page 12, what we have is the refiners versus the broader energy. So I just overlaid the XLE with the refiner space. And what we can generally see is the refiners have outperformed and done relatively better in general than the broader energy space. And this is one interesting area that I wanted to touch on. I mean, obviously, if we enter a period where there becomes a shock in the system, and let's say some event in the Middle East and the oil prices go skyrocketing because of a shock, then that would be a period where I would anticipate refiners underperforming. But unless we get something of that nature, this might be an interesting storyline. Gasoline's doing very well, crack spreads are widening again, and refiners may generally be a better place to be. And so one of my interesting ideas to watch over the next couple of months is whether or not sort of a long-short combination of being long refiners against short the broader XLE will work. And that's definitely one of the things that I'm going to be watching.
Boy, I'd love to ask Pat Hemsworth that question. As you were talking, the thing that hit my mind is I think a lot of the reason that the refiners have performed so well is there is a glut of refining capacity in the United States, but there's a deficit globally. And what I would start to think about is, okay, in the future, are we going to see a lot of capital available to build more refineries around the world where the finished products actually get consumed? Because, for instance, in South America, they don't refine a lot of their products. They end up buying finished products like gasoline, and they buy them from somebody like Pat Hemsworth and put them on a ship and send the finished product rather than the crude oil down to those countries. So are those countries going to build their own refineries, or are they going to continue to rely on U.S. refining capacity, which seems to have become a very important export for the United States, is finished products as opposed to just crude oil itself? I don't know enough about it. That's a question for someone like Pat. Let's ask her next time we get her on the program. Meanwhile, Patrick, we don't have Pat on the program this week, but we do have you every single day at Big Picture Trading. So, listeners, I want to encourage you again to check out the free trial at Big Picture Trading. You got the details there on page 14.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.